If you are considering selling your company to an employee ownership trust, understanding the future of the UK's 0% CGT relief could be extremely important.
12%. That's the number. Listen, if you're a UK entrepreneur who's been banking on a tax-free exit, I really need you to listen carefully right now. Because that famous 0% tax window hasn't just started closing. As of November 26, 2025, it's slammed completely shut. If you're planning a business transition right now, 12% is your new reality. So, welcome to this explainer. Today, we're tackling the absolute biggest question that's keeping ambitious UK business owners awake at night right now: selling your company to an employee ownership trust, or an EOT. Is the 0% capital gains tax window actually closing in the UK? Well, we are going to break down exactly what the latest government budgets mean for your wealth, your exit strategy, and ultimately your legacy. To help us navigate these highly complex new regulations, we're bringing you this analysis in partnership with Pro Tax Accountant, or PTA. They are your trusted premium UK accounting firm, actively guiding business owners through these exact structural tax changes with completely bespoke strategic advice. Because let's face it, with stakes this high, trying to navigate this new financial landscape alone, it's just no longer an option. Okay, let's dive into this. Quick look at the agenda for today's briefing. We're covering: is the window closing, the current rules and stats, who EOTs actually affect, crucial compliance steps, costly mistakes you've got to avoid, and finally, your immediate next steps. Section 1. Is the window truly closing? Let's look at the November 2025 reality. Let's just address the panic over the recent autumn budget announcements head-on. The short answer is, unfortunately, yes. The absolute 0% capital gains tax window is totally gone for new qualifying disposals. Basically, the government noticed the cost of this relief was forecasting to hit something like 20 times their original estimates, so they took decisive action to raise revenue. Instead of a 100% full shelter, we now have a strict 50-50 split. 50% of your qualifying gain remains completely exempt from capital gains tax. Fantastic. However, the remaining 50% is now fully chargeable under normal CGT rules. This is a massive, massive structural shift in how business exits are taxed in the UK, and it fundamentally alters the math for founders looking to sell. Section 2. Let's break down the current EOT rules and stats. And this brilliantly illustrates the new reality. While the EOT rate is no longer 0, it's now sitting at an effective rate of around 12% on the total gain. You absolutely have to compare it to a third-party sale to see the true value. A standard third-party sale will now cost you up to 24% in capital gains tax. This is crucial because standard business asset disposal relief rates are also aggressively climbing. It's the comparative advantage that truly matters here. So while it's undeniably a major tax shift, EOTs actually remain an incredibly competitive exit strategy when you measure them against your other options. Let's ground this abstract tax law in absolute reality for a second. Imagine you're looking at a £1 million gain. An EOT sale under the new rules means you'd pay a maximum tax of roughly £120,000 as a higher rate taxpayer. On the flip side, that exact same £1 million gain on a third-party sale, that hits you with up to £240,000 in tax. Literally double. That is a massive £120,000 difference. That's capital that stays directly in your pocket or can be reinvested into your next venture, all while securing your company's independence. Time for a quick insight segment. Did you know the £3,600 tax-free employee bonus still fully applies? Yes, even with all these CGT changes for founders, employees of employee-owned businesses, think brands like Riverford and Lush, they can still receive a fantastic income tax-free annual bonus. Now, national insurance contributions do still apply, but this remains a brilliant, highly effective tool for staff motivation and retention that was completely untouched by the November 2025 changes. Just a huge win for your workforce. Section 3. Who do EOTs actually affect? The EOT structure was originally introduced back in 2014 and has grown to over 2,000 businesses since. But who is this primarily for? Well, it's specifically designed for UK trading companies or the principal companies of trading groups. We see this heavily utilized by retiring founders seeking alternative exit routes to, say, a traditional management buyout or an aggressive private equity takeover. Let's be honest, a private equity buyout often completely changes a company's carefully curated culture overnight, sometimes focusing purely on aggressive cost-cutting. An EOT, by contrast, is absolutely perfect for ambitious companies wanting to attract and retain key talent by giving them a real, tangible stake in the wealth they help create. Above all, it's for founders who care deeply about protecting their corporate legacy. Section 4. Crucial EOT compliance steps. Right, let's move to and see how this builds, because the Finance Act 2025 introduced vital structural and governance reforms to stop tax avoidance. You must hit this holy trinity of compliance to qualify for that 50% relief. Step 1. Obtain an independent valuation. The trustees must take reasonable steps to ensure they don't pay over market value. This requires rigorous, defensible accounting. Step 2. Ensure UK trustee residency. The days of offshore EOTs designed to escape tax nets, officially over. Trustees must be UK residents as a single body at the exact time of disposal. And step 3, relinquish board control. This is a big one, guys. As a former owner, you cannot indirectly control the company by stacking the EOT board with yourself or your connected persons. You genuinely have to let go of the reins.
Here is a critical professional tip directly from the experts at PTA. Don't let your completion date slip into a new tax year without updating your valuation. The legislation explicitly states the disposal must perfectly align with the tax year the trustees acquire control. If your deal drags on, crosses over into April, and your paperwork is out of sync, your entire tax relief could completely unravel on a mere technicality. Timing is literally everything when executing this structure. But hey, there is incredibly good news on the funding front. Company contributions to EOTs are now officially confirmed in legislation as tax-free receipts. So what does this actually mean for you? It means when your company uses its future profits to make contributions to the trust, specifically to pay you, the seller, for your shares over time, or even to cover stamp duty, HMRC has confirmed these are strictly not treated as taxable distributions or dividends. This provides huge financial clarity for founders relying on deferred consideration, which simply means you're getting paid out over several years from the company's future profits rather than all at once on day one. This new clarity ensures those payments aren't hit with nasty, unexpected tax charges. Section 5. Let's talk about costly mistakes to avoid. So the crucial point is that this tax relief sits on top of a commercial structure, and it requires strict, ongoing compliance long after the ink dries on the sale. These are what we call disqualifying events. If the company loses its trading status, or if the trust somehow loses its controlling interest, you are in serious trouble. Another major risk is breaching the 40% participator fraction. In simple terms, this means there are too many continuing shareholders and directors left in the business relative to the total number of regular employees. If that ratio exceeds 40%, or if your trustees suddenly move offshore, the entire tax advantage structure completely collapses.
And how long do you have to worry about this? 4 years. That is the new extended clawback period. The autumn budget aggressively extended this from 1 year to 4 full tax years following the year of disposal. If any of those disqualifying events we just looked at happen within this 4-year window, your 50% CGT relief is retroactively revoked. You, the seller, will be assessed for tax at the standard higher rate, as if you never claimed the relief in the first place, leaving you with an unexpected, massive tax bill. You absolutely cannot treat an EOT sale as a one-and-done, single-day tax event. It's a real long-term commitment.
Section 6. Disclaimer and next steps.
Look, if you are looking at an exit strategy right now, you need to update your net proceeds modeling and get expert feasibility advice immediately. Contact Pro Tax Accountant, PTA, to understand exactly how these changes affect your specific business. You can call them directly on 07985 689912 or email them at info@protaxaccountant.co.uk. You can also visit them on the web at www.protaxaccountant.co.uk. And hey, if you found this explainer helpful, please hit subscribe on the PTA YouTube channel so you never miss a vital financial update like this one. Now, before we wrap up, I must quickly state our disclaimer. This explainer is for informational purposes only and does not constitute formal legal or tax advice. The tax landscape is constantly shifting, and these are highly technical regulations. Please make sure to contact Pro Tax Accountant directly for bespoke, tailored guidance before making any financial decisions regarding your business. So, I want to leave you with one final provocative thought. Is your business ready to truly embrace employee ownership, or are you going to let tax complexity dictate your legacy? The absolute 0% window has indeed closed, sure, but at a 12% effective rate, the door to a sustainable, independent, and highly tax-efficient succession is still wide open for the right founder. Don't leave it to chance. Reach out to PTA today and take control of your exit.